Hi there, this is Jenny Clark. I'm the GovCon CFO. If you're in federal contracting, I have something important to share with you about pricing. Today's topic is stop guessing, start knowing. There's a magic formula that determines whether you win a contract and make money, or you win a contract that makes you constantly worry about cash flow. That magic formula, it's your wrap rate. By the end of this session, you'll know exactly how to use the magic formula to calculate your wrap rate, and you'll never have to guess on a proposal again. 3 questions for the room. Answer these out loud, in your head, at your car, at your desk, wherever you are right now. Have you ever opened the proposal workbook and wondered what percentages to use? Are you still using the same indirect rates from old proposals? Have you ever started a contract and then the people you put in resumes for won't accept your job offer? Or are you recruiting and onboarding just in time for a prime to poach them? Are you pricing low out of fear and then struggling with cash flow? It's a gut punch when it happens to you, but you're not alone. And you're exactly who this session was made for. Meet Katherine Johnson. Katherine Johnson was a mathematician at NASA, and her calculations had to be perfect. Not close, not good enough, not a reasonable estimate, exact, because people's lives depended on it, on the numbers being exactly right. Understanding and managing your wrap rate gives you superpower, just like Katherine Johnson. You don't guess, you don't round up and hope. The numbers protect you and your profit. This equation is running in your business right now, whether you know it or not. The only question is whether you know how to manage it, whether you're managing it or it's managing you. Katherine Johnson didn't just calculate trajectories. She walked into rooms where people looked past her, where people doubted her, where people tried to limit what she could do. And she made herself undeniable with the precision of her work. They couldn't argue with her math. In this room right now, we know that feeling. We've always had to show up twice as precise, twice as prepared, twice as professional, and still fight to be seen as the expert in the room. And right now, with everything that's happened to the federal workforce and federal contracting as well, jobs that were eliminated, careers that were disrupted, a disproportionate number of those were Black women. Women who were qualified, who were committed, who showed up every single day. Katherine Johnson matters because the math was always right. Your math needs to be right too, because you deserve to be paid exactly what you're worth. Not less, not approximately, exactly. And I want to help you get there. Here's the secret to profitability in federal contracting if you're in the services end. Master your labor cost. Master the balance between your direct staff that generates the revenue and your indirect staff and those indirect costs. You have to have enough people as direct employees, billable employees, generating the revenue to pay all the other costs. And you have to understand those indirect costs to get that balance, figure out what that formula is. Direct employees generate revenue. Indirect employees are fixed costs. Your indirect costs are split into what are called pools. There's one for fringe, your fringe benefits, one for overhead, the technical cost of the work you do, and G&A or corporate, general administrative cost. There are 3 rules for managing profitability in the services model. It's like there's a golden ratio, and to me, it's always been one indirect employee for every 10 to 12 direct employees. So if you're the CEO, there's a point at which once you're off billable yourself, you've got to build up that billable workforce before you can afford to hire somebody to help you. And that sustains as the business grow that ratio. There's a rule of thumb in the services industry that you need to keep about 80% of your workforce needs to be billable. That's the way that you generate enough revenue to cover all the costs of the other people plus the indirect cost to support the business itself. And it really helps to have a dynamic model that tracks your rate so you know where they are now, next month, end of the year, into next year, and beyond, because you're bidding multi-year contracts. Let's talk about a wrap rate, a billing rate. There's so many different ways that people describe it, just like the term on-site or off-site. First, you have to baseline who's talking which site. Okay, is it customer, government, where? A wrap rate is the hourly billing rate that you charge your government client. It wraps together every cost of doing business plus your profit into billing rates. If you miss any one labor, you're going to be losing money on every hour you bill, and you're locked in with low rates for the life of the contract. Fringe, overhead, and G&A are also called burdens. So let's talk about layer one. That's direct labor. That's the annual salary you gave to that billable employee in their offer letter. Annual salary divided by 2,080 hours. 2,080 is 52 weeks times 40 hours per week. Layer two is fringe. Fringe is what you're doing to take care of that employee because they're your employee. There's certain that are required and some that are optional. Payroll taxes, Social Security, Medicare, federal unemployment, state unemployment, workers' comp, holiday. There's 88 federal holidays. Paid leave could be vacation, annual leave, sick leave, depending on how the combination needs to work according to the contract and your own company policies. And then there's company paid insurance, like health insurance, and 401k if you offer it, the 401k match. You control the benefits package and the cost, so be competitive, but watch out for your own generosity. It's a balance between attracting and retaining employees and balancing the demographics of your workforce you have. Layer three is overhead. That's the cost of supporting the technical staff and the technical work that you do. That's what makes you uniquely qualified to serve your federal customer. Costs like recruitment, managing their clearances, CMMC or cybersecurity compliance, skills certification, if you've gone out and attained preferred partner status, all of those are part of overhead. It's the support of the work that you are doing. Layer four is G&A, generally administrative. That's executive time. That's your paycheck. Accounting, human resources, legal, corporate insurance, proposal costs. Business development is a big piece of this and a big investment for you. That all comes under G&A. Layer five is fee. That's what the government calls profit. It's applied on top of everything else, and that is what generates the cash flow that you need, turns into profit that is for reinvestment and your growth and your paycheck. Here's how the wrap rate is built. For every hour of direct labor, fringe, I just picked a fringe rate of 21.5%, 8%, and I picked it so my math would turn out to a perfect number down there at the bottom of 1.5. 21.58% fringe covers your payroll taxes and some leave or some benefits. $1 times 21.58% is 0.2158. That's fringe times direct labor. Overhead is calculated as overhead percent times direct labor plus the fringe. So 1.2158 times 2%, 0.0243. G&A is multiplied times direct labor plus fringe plus overhead, 12% of the sum of those three, 0.1488. Your total cost in this example is 1.3889. Fee. I chose an 8% fee. That's typical, 6 to 8% if you're working cost plus contracts, 8 to 10, maybe if you're time and material, 10 to 12 and higher if you're doing fixed price. But I want to point out that on T&M and on fixed price, you're not actually going to make those higher percentages. That is only to give you the cushion, the manager reserve to cover the additional risk of those types of contracts. Sum all of those up and we come up with a labor multiplier of 1.5. So just stick that in your head. The wrap rate is the magic formula that you use in every cost proposal. Let me give some examples. If you have an employee with a pay rate of $50 an hour and you want to know what is the minimum billing rate I need to charge for that employee to cover all their costs and make my 8% profit, I take the multiplier of 1.5 that we just calculated times the $50 an hour, and that comes out to a billing rate of $75 an hour. For the $50 an hour person, I have to bill them out at $75 an hour or higher to make that target. We can do the math the other direction, flip it upside down. Sometimes I know the billing rate because I know a little bit about the contractor, I've asked around, or I've seen other information that gave me an idea that 75 would be the right rate for that labor category and skill level, all of that. $75 an hour divided by 1.5 gives me the pay rate of $50 an hour. So that's the way that you can use the wrap rate, the multiplier, backward and forward, upside down. But here's the important point that I want to make sure you understand with me. We have that multiplier that we came up with, and those are estimates. Inside your business, understanding what your real costs are for fringe, overhead, and G&A is how they turn into actuals. And managing those actuals, staying within your bid ranges and your actual cost is the way that you make sure that you're growing and profitable as a federal contractor. Here's an example. Let's pretend that my multiplier overall someplace between fringe, overhead, and G&A, it went up by 5%. It's not a big increase. Then my multiplier would be 1.575. If I take $75 an hour divided by 1.575, my break even is now 47.61. So here's what happens. I hired somebody that is brilliant, customer loves them, they do a great job at $50 an hour. Because my indirect rates went up, my break even is 47.61. I'm losing $2.39 an hour for every hour that person works. The kicker is your bid locked in the bill rate. Overrunning your indirect rates by just 5% and you lose $2.39 an hour. That's just on one employee. It's on every employee, every contract, every year. So understanding the math will really help you make better decisions. I've got this wrap rate calculator online. If you look at the QR code, go straight to the wrap rate calculator, and I encourage you to give this a try. It's got a place where you can enter your fringe rate. And the first time you make a pass on this, what you might want to do is use my exact same percentages, 21.58% for fringe, 2% overhead, 12% G&A, and 8% fee, just to see that the 1.5 calculation works. Then go back in and play with it. Put a fringe rate that's probably more realistic, somewhere between 25 and 30%. Your overhead and G&A, overhead just kind of depends on the work you're doing, but 2%, unless you've got people working in your offices, probably pretty good. And then G&A, maybe go from 10 to 15%. Small businesses, it's normally going to be a little higher than 12%. and put in your fee that you'd like to get on this contract because you're taking into account, is it cost plus fixed price or T&M? Just see what it does. When you do that, I also will send you a copy of a wrap rate guide that I created that goes into depth on fringe, overhead, G&A, gives you some typical small business ranges, talks about unallowable costs that come out of your profit because they can't be built into your rates. And the most common one is interest expense. And then I want to encourage you also, it tells you why to calculate it forward and backward. And I'll send you this once you try the wrap rate calculator. Here's the thing. Let's talk about your complete financial strategy for pricing and managing your costs inside your company so that you know you're making money. Wrap rate calculator was step one. Rate and pricing model, RPM, is where it grows into your complete financial strategy. The rate and pricing model shows you real rates for fringe, overhead, and G&A. So you can stop guessing and start knowing. Here's the part most contractors never figure out. Once you know your indirect rates, your win rate goes up and so does your profit. My rate and pricing model gives you superpowers. Imagine having a pricing tool that scales with your growth. Here's what the wrap rate calculator ties to the rate and pricing model. This is where your actual indirect rates come from, not the ones that I made up to use it as an example, but what is the fringe and the overhead and the G&A in your business? What is it now? What will it be by the end of the year? And what do you project it to be as you're having to bid for future years when you're bidding contracts? Here's how the math works from your profit and loss or your income statement. Inside your profit and loss, there are sections for direct labor, direct non-labor, fringe, your fringe costs like payroll taxes, leave, group insurance. Overhead labor, that's the people that are working overhead. And your overhead non-labor might be some of your cybersecurity compliance. G&A, as I mentioned, is the CEO, human resources accounting, the people that are working to run the organization, the back office, whatever you want to call it. And then G&A non-labor might be some of the costs related to insurance and other expenses. So let's talk about this calculation. Mathematically, what I do is I take what's called the fringe pool, the total cost for fringe off my income statement, divided by the fringe base, and the fringe base is direct labor, overhead labor, and G&A labor. Mathematically, I take the 926,000 divided by the 4.2 million, and I get an indirect rate, a fringe rate of 21.58%. Similarly, with overhead, my overhead pool is $93,000. My overhead base is 4.7 million. And by the way, that's direct labor plus the fringe on direct labor. That's where I get my 2%. G&A, general administration, that's the cost of running the business. That's headquarter cost. That's corporate expense. 575,000 divided by 4.8 million is 12%. Knowing what those rates are right now in your business, being able to see where they'll be by the end of the year, being able to factor in future growth, including that it's March and by September, we're going to add 6 people as direct labor because we're winning this new contract. I need to know that now, but I also need a quick way that I can say, oh, they shifted it. It's not going to happen on March 2020, March of the next year. It happens all the time. So having a dynamic model that does these calculations so that you can understand them and that takes into account what your workforce is and what's going on in contract activity is so important. That's the rate and pricing model I created a long time ago. When you know your numbers, you win. Stop guessing, start winning. It's about your numbers, your profit, your growth. When you understand your own numbers, you build a business that sustains your family and your community, and you have choices. Katherine Johnson got the math right so others could go further. The solvability RPM gets yours right. It's your turn to win.